Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the great news coming out of the Fed's Jackson Hole meeting. Logan, welcome back to the podcast.
Paper, rock, scissors, labor over inflation. We have a baby pivot today.
Woohoo!
So it was interesting because late last night, CNBC called me and they said, hey, do you want to wake up in a few hours and let's talk about Jackson Hole, Jay Powell, mortgage rates, Fed rate cuts? I was like, sure. I don't really ever sleep anyway, so get up at 1:50 in the morning and do a 2:10 interview. I was really happy from what I heard today at Jackson Hole for this one reason. The Fed made it clear, at least Jerome Powell made it clear, and we should take his word maybe over some of the Fed presidents that say some crazy things, that the deterioration in the labor market, Sarah, the labor market finally, right? And because of that, as we always said it, they needed cover, right? They needed cover before they go to that next. So there's been enough damage done to where they can actually say it. There's enough deterioration in the labor market that, it's time to cut rates. But the more important thing was that we're open to being more aggressive if the labor market gets worse. That's the key. That's what you wanted to hear. You don't want the Fed to be like, okay, we're just going to wait until if things get worse, the bond market, everybody's kind of, okay, we're on page here. They'll be more aggressive. And there's so many other things the Fed can do. But they're open to it now, and they've let the market know that they're open to it. The 10-year yield went up all the way down to that 380 level. So it's early Friday morning and bounced off of that 380 level. So it's still a little pest. But considering everything that has happened, this is as good as you can ask for, because it tells the marketplace, hey, listen, you guys, you follow the jobless claims. If that jobless claims is getting worse, you can take the 10-year yield lower and, we could start, maybe getting to neutral or accommodative, but they made sure to let the markets know we'll go bigger if the labor market deteriorates. And that's kind of what you wanted to hear this morning.
No, best news right there. So you've been saying for at least 2 years that the Fed will not pivot until the labor market breaks. And then you've been following that labor market and you keep going, it's bending, it's not breaking, it's getting weaker, it's not breaking. So when you say a baby pivot, what does that mean to you?
A baby pivot means to me is that, they actually haven't cut rates yet. Right. So they've admitted that the labor market is deteriorating faster than they thought. So they don't want it to get worse. But then you're going to have to follow through with action. But the fact that the key thing is that during Powell's talk, he was saying, well, the jobs quits ratio, the openings, things that we have highlighted in the podcast, in our articles, we keep on talking about it. It was like, listening to one of our podcasts in March, the quits ratio is pre-COVID, the higher is the job. These things are what the Fed tracks. And we kind of highlight it. You guys told us to track this. We did. It's pre-COVID now. So they're there now where the labor market deteriorated enough with the growth rate of inflation. The growth rate of inflation fell last year, right? It's not like this all of a sudden happened. But they just needed the labor market to get weak enough to where now nobody's really going to go after them on this. So I think this is kind of the cover they needed, and they feel more comfortable going out, because if the labor market gets worse, they can say, hey, listen, we told everyone, if it gets worse from here, we're going to do more stuff. So that's a baby pivot, right? You just needed them to acknowledge that they don't want to see any more deterioration in the labor market. So that's a good thing. And also, he took a shot, which I loved, the people that said you needed to create 10% unemployment rates for 1 year, 7.5% unemployment rates for 2. You needed to create a job loss recession to defeat inflation. No, you didn't. This was a global pandemic. We have highlighted this time and time and time again. The history of global pandemics are inflationary, and then the disinflation happens, right? You didn't need to create a job loss. Look at what happened. So that's good. I could just tell that my extremely bearish loser friends who have terrible YouTube accounts are just like, because a lot of them wanted the Fed to be restrictive as possible and stay restrictive to create a recession. And then, but boy, not the best morning for them. Not the best morning every day for them. I mean, they got to wake up and just do doom porn. I mean, I got to tell you, it has to mess with your head. I mean, it can't be a good, healthy thing, but we are here. We are here now. The 10-year yield did bounce off of that 380 level. I'm just talking about Friday morning. I don't know how the rest of the day is going to go, but it is a much better place to be in today than a week ago.
I'm very happy to be in this place because we know, we have so many things. One of the things CNBC asked you about this morning was like, okay, at what level do mortgage rates really spur home buying? Right. And we know it's key, but maybe you could talk about what you told them as, like, what is that level?
So a few things with the CNBC interview. I told them what I've said here in the articles and in social media for some time now. The only marketplace I've seen sustain growth is actually the new home sales market. The new home sales market does have sub 6% mortgage rates. Okay, so they've shown us they can grow sales. Now, new home sales came out today, beat estimates. Okay, so one of the things I try to teach people, I'll try to teach people how to track the new home sales sector. And what had occurred the last 2 months, it's people still don't look at this data line. The forward-looking builders demand data got better. It wasn't great, but it got better. And then rates fell even more. So what occurred is that data line's a little bit old, but it improved. And now in the month of August, when Toll Brothers came out with their earnings, by the way, for that one stock trader who was yapping off on Twitter next to me, who wouldn't take me on a debate, your whole Toll Brothers is a bubble. If you were still short Toll Brothers after, I'm sorry. There is therapy out there. In any case, Toll Brothers actually talked about how their traffic got better in August. Okay, so the builder survey showed a little bit of improvement going out 6 months. Then the purchase application data for the new home sales sector, which is still funny to me that people don't know, the new home sales sector has a different purchase application data than the existing home sales market. So I highlighted that yesterday on Twitter. I said, so the builder survey got better, purchase application data got better, and Toll Brothers said August improved. Okay, so we got a beat in new home sales. Okay, so again, when rates fall below 7%, the builders can operate better there. That's what we've seen in the data since 2022. So we go with that. So Fed staffers, San Francisco Fed, Minneapolis Fed, I know you're listening. You can tell your bosses, push it down, get construction permits going, right? You don't want to have the residential workers lose their jobs now, because if you're highlighting, you're worried about the labor market, this is the one sector that is showing very recessionary data lines. Push it, go with it, get people to build again, right? We can't have permits at recessionary levels and starts at recessionary levels. We want to build all these homes, right? We look silly, don't we, Sarah? We're like, we want to buy millions of homes. Permits are at recession levels. Okay, come on, push it. Get things going again. It's a positive. You don't need rates at 7 or 8% area. Make it clear. Destroy the American bears, right? Go for it.
Okay, so let's talk about housing specifically. You said housing was in a recession on, was it June 2022? Or
June
July?
5th,
June
2022, 5:31 p.m.
Yes, it is forever hallmarked on our site at that time. You put housing as an industry, as a sector in recession. Tell us about that and whether you feel like where we are now, what happens to housing now?
So the existing home sales market is separate than the new home sales market. Actually, was it June 16th? Now that I think about it, it's been so long ago. I'm losing my memory. In any case, transfer of commissions, incomes. So imagine if the United States of America was in a deep contraction and real wages and nominal wages fell down. Well, that's what's happening in the existing home sales market. Transactions and jobs have fallen down with wages, and sales has fallen down to what I would always say, the third calendar year of the lowest home sales ever when you're adjusted to the workforce. You got to grow sales for some time to get out of that, right? And that's why I always say that the sub 6% mortgage market worked for the builders. We have never really tested that in the existing home sales market. That has not occurred. So that would be the first test. Can you grow sales, not have these bounces? We always talk about, we get these bounces and then rates go up and sales fall down again. We get these bounces, rates go up, sales fall down again. And what I told CNBC is the same thing I tell a lot of people. There was one period in time in history where affordability was worse, and that was the early 1980s. In the early 1980s, there was a recession, there was more inventory. Nominal home prices didn't crash back then, but rates went lower. 2.5% rates went lower, demand picked up. I always like to show that chart because you can see from a very depressed level, you can get sales to rise. That's what happened back then in the early 80s when affordability was worse. Rates 2.5% lower, stayed lower. You could grow sales. When sales start to grow, that means the transfer of commission industry starts to grow. Everybody starts to make more money, right? And then you could lift that sector out of a recessionary state. So the new home sales sector is totally, completely different because that's construction job, housing permit starts, big ticket items. That in terms of the economy and how you put the components into GDP, that matters more in that sense. That has now gone into permits are recessionary level, starts are. So you need new home sales to grow to make sure to get the housing starts growing again. So this is what happens, right? People don't build or buy when there's not enough demand there. And we're seeing it on two fronts. So this is where what we've seen in other cycles, rates go lower, and then housing technically lifts you out of recession because it disproportionately gets hit first, but it leads you out. So we haven't had that job loss recession. So the Fed could just go with it, get sales to rise, get permits start to rise, get construction starting to rise, and then we go with it. And that's why I'm glad that they said, we don't want to see any more labor market deterioration. I'm telling you, they have to be seeing the same data we do about how economic cycles work. So I constantly tag the Fed City Twitter accounts through some of the chart threads I do. I said, you don't want this to break on you guys. And now they're open to doing more. That's the key. So I always separate the existing home sales market and the new home sales market in a lot of things, but that's two different sectors, and how you view a recession here and how you view a recession here. And that labor jobs, those residential construction workers tend to lose their jobs going into recession. That hasn't happened yet. So we can land the plane. We can do it, right? We can destroy the American bears, right? It's just...
Okay, so I asked you this earlier this week, but now that you've listened to Jay Powell and his speech in Jackson Hole, do you think it's going to be a 0.5%? Do you think it's going to be a 0.25% cut when he does it?
They're open to what the data says, and I always say that jobless claims typically has been something they have recently made public, even though we've talked about it for since 2022. Jobless claims. If jobless claims start to deteriorate more, they will go bigger. I don't know if a 50 is here, but at least it's in the ball game now.
Yeah.
At least now we know that if the labor market deteriorates more, they're willing to do more. So that's a positive. And a good thing is, when CNBC asked me about this, I said, listen, the labor market runs the show on mortgage rates, but what Fed rate cuts can do, what Fed language can do, is get the spreads better. And if you just get normal spreads, 75 basis to 1% lower mortgage, that's you're under 5.5%. Just by that, you get the 10-year yield lower, you're sub 5%. That's it. That gets you there. And you go back to the history of economic cycles, early 1970s, before I was born, right? You can see that the spreads get worse. The spreads get worse and they get better.
Say something about me remembering the early 1970s.
I
You wanted
say
to
something
so
about you that I was not going to ask if you remembered how the spreads got better in the early 1970s, Sarah. I would never do that. No.
Oh my gosh. Anyone watching this on YouTube totally saw it on your face, but that's okay. Continue.
In any case, that happens. That's a big deal because the builders have said, hey, listen, existing homes, hey, we can grow. So can't get there. Yep. But if that happens, then it's good. And that's how you try to calculate some kind of model to get you there. And then if the 10-year yield, you don't even need the 10-year yield to break underneath the Gandalf line to get a kind of a very low 5% mortgage rates. If you have normal spreads, that could get you mostly there, and just the 10-year yield falling to get you there. So it's good, considering everything everyone's dealt with, especially the early part of the year, which, the base effects of inflation data was like, really, and they're look what's happened. They did what I thought they would do. They kept it as tight as possible until they actually felt comfortable saying that, okay, the labor deterioration is happening. We acknowledge it. Powell said it. He's like, job growth has slowed down. We're not losing jobs, but all these labor stats are not, are not heading up. They're heading down. So good. I mean, that's in this chaotic period, that's the best we can hope for. Now they have to follow through on it. And again, you always want it. If you really wanted to protect the labor market, you get ahead of the curve. That's why I say a baby pivot. I don't say that the full pivot. I know the Wall Street Journal said Powell did the full pivot. You gotta go through with it. See, Sarah, do you think I would hesitate in a second?
No. Mm-mm.
Like if the market knew, if I was, Fed president, the market would know, oh, he's ready to play. He's going to make sure that we're not in a recession. So you got to go to that next stage, right? And at least it's in the ball game now, right? That's why I say a baby pivot. We're in there. So the next thing is following through. Get the job done. Land the plane.
Okay, so if you were Fed president, would you keep your shiny shirts that are sort of your hallmark? Would you continue to wear those?
What's interesting? The CNBC anchor said, Logan, you're known for your hair. So I thought I'm just going to slick back the hair.
Yeah, it's a very Pat Riley look this morning.
It's a Pat Riley look, but he said, man, your shirt today, though. I was just like, yeah. So no, I wouldn't change.
You wouldn't change one thing.
And then if anybody asks me, why don't you wear a suit and tie? I go, why? I think this is who I am. So yeah. Unless they absolutely told me I couldn't, right? So this is me. You see me on stage. So
I see you on stage.
By the way, we are going to Las Vegas in the first part of October. Wait till you see the Las Vegas outfit. That's going to be prime time.
It's going to be amazing. Okay, I did want to bring up existing home sales, right? You mentioned them in passing earlier, but what else do we need to know about existing home sales?
So existing home sales bounced, and again, the forward purchase application data had 3 straight weeks of positive growth, and then the pending home sales went positive. It was supposed to be down big. It went up. So the forward-looking indicators actually here, and it gave you a little bounce in sales. I think what shocked people was the monthly supply fell. So all the doomers were like, okay, here comes the inventory. Monthly supply is going to spike up. And then all of a sudden they were like, whoa. I mean, when the doomers are literally asking me like nicely, hey, what happened with the monthly supply data? I said, well, demand got a little bit better. Total active listings didn't really grow. So monthly supply fell. Yeah, it's usually peaks in kind of October the last 2 years. But, so we just got a little bounce. That's it. Like I told CNBC, we're slightly positive in the purchase application data, which is actually the best part of the year. It's crazy to think this, but the last 11 weeks have been positive. Only 6 positive, 5 negatives. So that slight positive demand curve is actually the best 11 weeks of the year. Lower rates, right? Again, we've not tested the sub 6% market for the existing home sales. The builders have shown us now. This is the 2022, 2023, and now 2024. When rates get below 6 or below 7%, the builders tend to do better. They're doing better here. But we got to remember, they're also working from a lower bar of sales. The same thing with existing home sales. So it'll be interesting to test that theory. And another thing that a lot of people do ask me, when rates went lower in late 2022 and late 2023, we're closer to the purchase application data seasonal push higher. So you always see a little demand curve higher in the seasonality parts. It's just that rates also fell down close enough to boost up that demand a little bit better. So right now, it's a lot of people are disappointed, but also this, like I've always said, purchase application data second week of January to the first week of May. After May, total volumes always fall. You always keep a track of the data line, of course. But that's the seasonality curve. November, December, January, where rates were lower, that's close enough to that curve to give you maybe a little bit better boost in demand that people thought with rates falling. So we'll wait until the seasonality of this data line comes in, but got a small bounce in existing home sales. New home sales came in much better than anticipated today. So it's a good day. Sarah, it's just like today is just like, I'm just like, okay, it's considering everything that has happened, right? Existing home sales beat, new home sales beat. Powell had a baby pivot. The 10-year yield still hasn't broken 380 yet, but much better spot now than we were earlier in the year when that uptrend, on Instagram stories, I go, this is not good. We don't want this uptrend on a 10-year yield. That downtrend now, we want to keep that going. So we'll take it one day at a time, 1 week at a time. And again, labor data is the key. Now they've made it open in public. They don't want to see the labor market deteriorating anymore. So the question is, what's next? What do we do? How aggressive they're going to be? How low do rates need to go to make sure that the residential construction workers don't lose their jobs? So it gets more interesting, right? We're at this different phase out there, so this is the phase that I've waited for. So for the next 16 months, it's going to be prime time. Imagine me, number 21, like Deion Sanders of the economics nerdy crew. I'm ready for this. I've been waiting for this. This is my town. So I'm ready. Let's go.
I like it. Deion Sanders. I was going to say Mr. Worldwide, right? Like you and Pitbull, but okay. I wanted to give a shout out. So I'm at NAMBA at their NAMBA Connects conference. It's been really great and met a lot of our fans of this podcast. And I wanted to give a shout out to Malik Wilkes. He's a manager at Express Mortgage because he said that not only does he listen to us every day, but on his Spotify, you know how it tells you like how much you've listened to, that Spotify says that he's in the top 1% of our listeners. That's how much he listens to us. Usually listens when he's working out in the morning. So wanted to give a shout out to Malik. It was really great to meet him along with some of our other fans. So Malik, thanks for listening.
I pick on you because a lot of people tell me, do you have fun picking on Sarah? I said, I don't pick on her. I just kind of
I think what he said is that I do a good job keeping you under control, which a lot of
everybody says that. Keeping you cute. Really? I mean, you should let Logan listen. Imagine Logan unleashed. Can you just take the chains off and just see, nobody's ever seen it really, right? Oh God, it's a show. There's going to be an event where I get to, there's going to be an event. Something's going to happen where I go in my berserker mode, just like Logan does in the Wolverine comics. And it's going to be a show because I'm somewhat tame here because I know you're going to Logan, stop it. Cut that out of the video. So, but we're going to make it a lot of fun, especially with the newer tour. We have, I think 11 cities we're going to hit in the next 6 months. And things get a little bit more interesting, a little bit more exciting. Remember last year, the Fed went hawkish at the Fed meeting. 10-year yield shot up to 5%. We're at 8% mortgage rates. And I was like,
we're in such a better spot now. I'm so thankful.
Better spot.
This is good. That's good. Logan, thanks for bringing it. Thanks to our listeners, and we will talk to you again soon.